This is InvestTalk. Independent thinking, shared success.
Hey, Justin. Yeah, I own GEV. I actually got a few shares of it. I bought GE a long time ago, and I've been holding on to it.
Mm-hmm.
I'm looking to know if, what type of price would be a good opportunity to add more. The stock is super volatile.
Mm-hmm.
It's been moving all around, but it's been coming in, and I'm seeing revenue growth expected to reaccelerate next year, also profitability accelerating as well. So I'd love to get your take on this one.
So this is an interesting one. This is a spinoff from GE, correct?
Yes.
Okay. And it has three segments: power, wind, and electrification. So power is gas, nuclear, hydroelectric, steam technologies, etc. Then there's a wind segment. Obviously, that is becoming a bit more challenged, especially under Trump, with on and offshore wind. And I'm not too optimistic about that part of the business longer term. And then electrification, which is grid solutions, power conversions, electrification software, solar and storage solutions. And I kind of like that business overall, not just because of AI data center demand, which I do think is ebbing a little bit, but modernizing electric grid, etc. So I generally like that part. Let me see if I can get some data here. It's a recent spinoff, so some of the data is not as fresh. Yeah, so 46% of the revenue comes from the United States. So that means the majority does come abroad. I do kind of like that. Let me see here. Supply chain, I'm looking at, just trying to get to our other data points. Yeah, it's pretty complex, so I don't really have time to really dig too deep into it. I like the business, good profitability, 15%. The issue is the valuation. Enterprise value to EBITDA is 41, very high. Enterprise value to EBITDA is 114. Price to sales ratio is at 2.5. That's not crazy, but price to cash flow, price to book is at 9. Price to free cash flow is at 51. It's just not a good valuation, and the chart is starting to weaken after that reversal. So I frankly am not a huge fan of adding at this point, and I would have an out below the recent low. I think if it breaks below this recent low, those multiples are going to contract dramatically. And that recent low, what is that? Around 266? Yeah, in that range. So if RYCEY say 260, I would probably actually be out of this. I think it's going to have a major downdraft, and I am not optimistic about this name in the short term. Longer term, if it gets to reasonable valuations, I would own it, but I would not be adding at these valuations.
All right. Thank you.
Thanks for the call. That was GE Vernova. Now, let's pivot over and take a question that came in via the comment section on our YouTube channel. Rock Don says, what are your thoughts on RBC Bearings? Small to mid cap, looking like a solid company, no dividend, but probably a little overbought. They do buybacks. If you like it, where would you get in? Thanks, Pakistan Don. All right, let's take a look at RBC Bearings. Not RBC Capital. I always think RBC Capital, the foreign bank. But this is RBC Bearings. This is in the industrial space, and they're headquartered in Connecticut. And it's an international manufacturer, marketer of highly engineered precision bearings, components, and essential systems for industrial, defense, and aerospace technologies. I generally like this type of business. Free cash flow about $258 million on about $11 billion enterprise value. Not amazing. It's about a 2.5% free cash flow yield. Not great. Okay. No dividend yield. They are taking that cash flow and they are buying back shares. I'm not sure where you got that. They've been consistently issuing shares, actually. So if you go back to 2005, they had 16 million shares outstanding. Now they have 31 million shares outstanding. And they had 29 million shares outstanding as recently as July of last year. So sometime in, it looks like September, they issued a bunch more shares, about 2 million more shares. So diluting shareholders. So I'm not sure where you're seeing the stock buyback thing, but they do have a good balance sheet, $1 billion in net debt on a $10 billion market cap. There's no problem there. Overall, I like the business. I just don't love the valuation. And so, I give it lukewarm. It's fine, but I think there's better industrial names out there to buy. That was RBC Bearings Incorporated. Let's go take a live call and talk to Frank in San Rafael, and he's looking at FedEx.
Right. Long-time listener way back to Peasley.
Appreciate that. I know you're looking at FedEx, and do you own it or looking to buy it?
I own it. I don't know whether to sell it or hold it.
Okay. Well, here's the issue. They move physical goods. And if the cost of those physical goods are going to go up, then I think they're going to struggle. Now, the question is that all priced in? Because the multiple it's trading at is definitely on the low side. So it's cheap, but cheap on the cheap side. Not super cheap, but on the cheap side. But it certainly could get cheaper. The technicals are certainly in a downtrend. You got a nice reversal off the, I would assume, earnings. Was that earnings about a week ago?
Yes.
And it's reversed that. That's nice. So this is going to really be predicated on the tariffs. This is one of those names that's going to be directly impacted on how well the market accepts these tariffs or not. If they think they are extremely contractionary or modestly so or no big deal at all. This will be a good indicator for that. Overall, FedEx is a great business, but clearly there are headwinds in the short term. But once again, how much of that is truly priced in? Return equity is 14%. So very solid business. I love that. The amount of debt on its balance sheet is on the high side because it's a very capital intensive business. Just consider all the planes and trucks and distribution facilities, et cetera, that it has to own to efficiently run its business. Now, the good thing is that debt has come down. Its free cash flow is about $3.4 billion, and that still remains near all-time highs. But there's a lot of uncertainty with its business in the short term. Typically, that's a longer-term buying opportunity, and enterprise value to EBITDA right now is at about 6.9. That is on the low side of where it tends to trade historically. So once again, it's on the cheaper side, but can get cheaper if these tariffs bite harder than the market is expecting. So this is one of those ones where TBD, we'll find out tomorrow. It's either going to probably rally strongly or sell off harder. And if it sells off harder, that's a clear indication that this business will be impaired for a period of time, and maybe that's a time to sell. Thanks
okay, I'll hold on to it for a couple of days and see how it goes.
Yeah, see how it goes. Thanks for the call, Frank. Now let's pivot over and take a question that came in via the comment section on our YouTube channel. And Gil Tel Aviv says, I'm looking to add some aerospace and defense stocks to my portfolio and wonder which of the following stocks are better to pick up. Rheinmetall or Rolls-Royce? Rheinmetall or Rolls-Royce? Now, Rheinmetall is one of those ones that has, if I remember correctly, that is done very, very well due to the amount of money that's going to go into aerospace and defense stocks or defense spending in Europe, because they are active in various markets, leading technology products and services. It focuses on security, technology, and mobility. And it has 5 divisions: vehicle systems, weapons, ammunitions, electronic solutions, sensors, and actuaries, and materials and trade. So it's well diversified, but right in that zone of the type of business that is going to really do well if those European countries spend a lot on defense. Now, it's gone up a lot, so did you miss the train? Maybe. What I would say here is I would diversify my bets. I'd buy both. I think Rolls-Royce will also benefit. It's also one of those names out of the UK that has diversity around jets, wide-body aircrafts, both in civil and military. And they also have power generation divisions, and just it's a very solid business. So I have no problem with either. A lot of the expectations have been built in, but these are type of names that have been depressed for a long time. And so I think there's more room to run before consolidation, period. And that's what you're in now. So I would actually buy both, because both are good businesses, and I do believe both will benefit. Now let's talk a little bit about gold miners. Gold miners, they tend to underperform, but they're starting to outperform. I think that's something of note, and what most people are not talking about is that you're starting to get the gold miners to really have some nice outperformance as of late compared to gold prices, especially since the start of the year. Now, historically, gold miners have just underperformed gold because of their input costs and the fact that those input costs have been rising faster than expected. But a lot of those fixed costs have been locked in just a couple of years ago, and the variable costs are becoming more in control. So typically labor costs are one. And so what that means is that they have operating leverage, and that operating leverage is finally working, meaning when gold prices are above the cost of production and gold prices go up, say $10, that's $10 that typically goes right to the bottom line of the gold producer. That is called operating leverage. It cuts both ways. It works bad when prices are falling, but it supercharges profits when things are going well. And that's what you are seeing. Not only are these companies more profitable and producing more cash flow, but they're also being more disciplined. This kind of reminds me of the shale industry. Back in the early 2010s, the shale industry was booming, and all of those companies went out there. There was M&A activity. It was drill, baby, drill. Right? It was everything that Trump had dreamed of. Problem is they drilled too much, and they created overcapacity within the industry, and there were a lot of these companies that were overpaying for smaller names. And just like in that industry, there were lessons that were learned. And in the gold industry, that's happening as well. Where the last time gold boomed, back in, what year was that? I know it was post-financial crisis. Gold did very well. Let me zoom out to a monthly chart, just so I can remember this. Yeah, so that was 2012, right? Gold really surged kind of post-financial crisis, and then it had a long, I would say, consolidation period from 2012 all the way until it broke out in 2019, even before the COVID crisis. And it's just been on a tear since. But during that roughly decade, there was a lot of consolidation, and there was a lot of realization that they overspent for acquisitions in many cases. And so now the deal size they're not as large, and they're just not doing as many deals, which is frankly good. Means that they are producing more cash flow and more earnings organically. For example, Barrick Gold, one of the largest gold miners, has now a free cash flow yield of 9.5%. And one example would be the Canadian miner Kinross Gold, small Canadian miner. They doubled their free cash flow last year. What do? They increased their dividend and they bought back shares. Now, I'm not saying you go buy either one of those, but those are good examples of what's happening within the industry. And so if they just continue to print cash, what are they going to do with that cash? They're going to buy back shares. They're going to make smart acquisitions. And there's a lot of catching up to do because they drastically underperformed last year, and they're starting to catch up this year. So that leverage, when times are good like this, when gold is hitting all-time highs, it really shines through to profits in these miners. So I wanted to highlight that. They're certainly higher risk, but you're starting to see them outperform and that operating leverage really shine through. Now let's fit in another listener question right now at 888-99-chart.
This is Bruce from New York. Been an avid listener for over 15 years. One of the rules I try to follow is to sell half of my investment once I reach 100% gain. Then I get greedy and try to talk myself out of following the rule. Please look at VYM, the Vanguard Whitehall Fund's high dividend yield, and give me your opinion of my next move. It is a small part of my overall portfolio. Thank you.
All right, looking at VYM, which is the Vanguard High Dividend Yield ETF. Now, this is a name that is well diversified. So these are the type of names that you would let run, because even if a handful of these names get crushed, it's well diversified, and you're not going to lose a dramatic amount of money unless, the whole market really goes to hell in a handbasket and you have like an '08 type of crisis, which I don't see on the horizon, but anything's possible there. The other question you have to ask yourself is, what would you do with this money? What are the other options here? What's the other broader allocation that you might have? Now, the way you want to look at this is not by the name of high yield dividend ETF. It's not. It's the type of exposure that you have to the equity markets. This is effectively a large cap value ETF. Throw out the high dividend yield ETF. If you go look at a large cap value ETF, it's going to look very similar. It's going to have a portfolio that looks a lot like this. Now, is a large cap value ETF better? Probably. I'd have to go look at, the two. But generally, one thing I don't love about the high yield ETFs is that it ignores everything else. Just looks at the yield. Now, generally, good companies that pay high dividends, it's smart for them to do so, mainly because it keeps the management in line. It makes them penny pinch. It makes them not go out there and overspend on acquisitions because they have a ton of cash sitting on their balance sheet, burning a hole in their pocket. And they return it to shareholders that can reallocate that money more effectively. So that's what dividends are really good for. So I would rather own a large cap value ETF. So that's probably what I would do. I should also consider the tax consequences. I'd look at the other assets you have in your portfolio. How much overlap is there here? Do you have any concentration? Because that's one thing that most people don't realize when they own mutual funds and ETFs and target date funds, is that underneath the surface, you own a bunch of different names and there's a lot of overlap between different funds. And so you may be highly exposed to the Mag 7, for example. Now, in this case, you aren't, because the top names aren't the Mag 7. Talking about Broadcom, JP Morgan, Exxon, Walmart, Procter & Gamble, Johnson & Johnson, Home Depot, AbbVie, Bank of America, and Coke. So those are the top 10. Like I said, it looks more like a large cap value ETF than high dividend. Now, one issue I see is those top 10, I'm looking at Morningstar, only half of them are only 3 stars, which means they're fairly valued. And the rest are either 1 or 2 stars, which means they're overvalued. So that's another issue I'm seeing with some of these names where they are a bit overvalued. And so I would think about selling some and diversifying, but depends on what your other holdings are. So I'd encourage you to do a portfolio review with me.
Hi, guys. I was interested in adding a chemical stock to my portfolio, and I was looking at Dow Incorporated, symbol DOW, and I wanted to get your guys' opinion on it. Thanks a lot.
All right, looking at Dow Chemical. Most people know Dow, one of the largest chemical producers in the world. And this is your classic value trap. It looks cheap. Actually, no, it doesn't look that cheap, actually. Earnings supposed to be $1.73 this year from $1.71 last year. up 1%. Supposed to be $2.46 next year, but those estimates continue to come down both this year and next year. And it's still a $34 stock. So you're still talking about a 20 times earnings multiple, so a market multiple. It's down dramatically, 43% from its 52-week high, but even further down from its all-time high around $70 per share. Now it's at 34, so it's down about 50%. And it's yielding 8%. So probably looking at that dividend yield and saying, hey, you're chemical producer, big name, yielding 8%. It's got to be good, right? The simple answer is no. Its payout ratio is 176%. Its cash dividend payout ratio is negative because their cash flow is negative, meaning this dividend almost certainly will get cut, and probably relatively soon, and that's what the market is pricing in because the debt levels are high. You're talking about $14 million in net debt on a $14 billion in net debt on a $24 billion market cap. And when you have that much debt and you have negative cash flow, the market starts to worry that you are now in a position where you may default on that debt. You can't support that debt. And what happens when you can't support debt? It's called bankruptcy. So, can Dow turn it around? Maybe. But I would look into what's really driving this. I haven't looked at Dow in a little bit, mainly because, this data is not enticing for me to jump into it. But I would certainly pass on this. There's too much risk here. Even though it's one of the largest chemical producers in the world, it's clearly is struggling. Now, I think part of this, I remember correctly, I believe it's their European operations. I know that's been one issue. Cheap natural gas coming from Russia was a big factor in the business of Germany. And so companies that operate there are struggling. And I think that is part of the issue with Dow. So, and then I look at the chart, it's not inspiring anything. Once again, it's down 50% from its high. It's every bounce gets sold at the 50-day moving average. And I would pass on it until you, at least at the bare minimum, I would need the technicals to improve. That's usually the start of this, right? Is the market starting to wake up that, hey, a turnaround is beginning. These things don't go from a strong downtrend to skyrocketing overnight. You typically get some sort of capitulation. You get some sort of reversal bar on high volume that signals that, you know what? The markets are becoming more optimistic. There's something tangible here that is turning. But that's not the case here. It's absolutely in a strong downtrend with a ton of debt, negative free cash flow, very likely to cut that dividend soon. So this is your classic, in my mind, value trap that people will get in looking for that dividend and then be surprised when they cut that dividend. And then the stock will probably drop 20, 30, 40% on that news. So run from Dow, look elsewhere. That is not a name that you want to buy right now. Now, lastly, let's talk about a study on AI. And this looked at 30,000 firms, and those among that adopted AI. And what they saw was that they were trying to replace workers, but their productivity actually declined, at least initially. And what the study ultimately says about AI is that it's not a panacea, first off. And early on in adoption, it doesn't help. It actually takes away because it throws the established practices out the window. And it's hard for the humans that are still involved to adjust. But over time, it does help with sales growth, productivity of employment. And this is if the management really gets through the initial growing pains. And this is in the manufacturing sector, so not service side. So that was an interesting study that shows that AI is good, but mainly in the long run. and often not in the short run. I'm Justin Klein. This completes another InvestTalk program. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, Google Play. Be sure to rate and review on iTunes. Independent thinking, shared success. This is InvestTalk. Good night.